Good afternoon, everyone, and welcome to today's session. I'm Melissa Desmarais, the Executive Director here at Highwater Women, and I'm very excited to have our panelists with us today to talk about the future of asset manager. We have amazing women who have all started their own firms and here to share with you their lessons learned in their thinking and how they have approached their business. So without further ado, let's dive right in. We are Highwater Women, social change powered by professional women. Our mission is the economic empowerment of women and youth, and we do that really through three core programs: financial literacy program, backpacks, and impact investing, which is the core of the session that we are here to talk about today. We launched Investing with Impact back in 2013. We were the very first symposium of its kind here in New York City. And since then, we've presented 371 speakers, over 122 sessions, and have had over 2,000 people participate in our workshops and events. So we hope that you want to learn more about that. We have some upcoming events I want to make sure that you know about. This panel has a part two. Today we'll hear from women who have started their own firms. And in our next session that we're putting together, tentatively scheduled for May 20th, we'll hear from women entrepreneurs who have started their own businesses, kind of from a non-asset management side. We have some events coming up in the fall that you can see here. And we hope that you're able to join us for those as well. For more information on how to become a partner of Highwater Women, please feel free to reach out to me, and to donate to our cause to support this work, please visit our website to do that. So without further ado, I'd like to introduce Valerie, who is a member of our Young Women's Council and someone who helped to organize our panel today. Valerie.
Thank you, Alyssa, for the excellent introduction. So welcome, everyone. The overarching theme of today's webinar, you can already tell from the title, is Women Entrepreneurs in Asset Management. We will dive into the career trajectories of our impressive panelists and discuss the different inflection points along the way, challenges and hurdles they've had to overcome, and the evolution of the firms they founded and manage today. We will begin with introductions from each of our speakers, bring everyone back for a group discussion, which will take us up to the hour, give or take, and use the remaining time to address any questions you may have. As always, if you have any questions you'd like to ask during this time, please feel free to submit them using the Q&A function below or the chat function. And before I turn it over to our moderator, I'd like to thank TriLinc Global for their support in making this work possible. And now I'll hand it off to Susan Webb, who many of you know as one of our own. She's the founder, CEO, CIO of Appomattox Advisory, and a member of Highwater Women's Board of Directors. Susan, over to you.
Great. Thank you so much, Valerie. And I hope everyone is excited about this panel as I am. Someone who founded their own company approximately 20 years ago. It's heartening to see that there's still women out there trying to, one, launch their own companies, and two, launch their own companies with a focus on sustainable investing, impact that they may be having through their investing around the world, as well as many other aspects of what we at Highwater Women have emphasized as a board: environmental focus, social governance, social focus, and contributing to the community writ large. The three people we have with us today are Jillian McIntyre, who's still in the process of launching her long-short equity fund focused on many aspects of ESG investing, with a bit of a focus on greenwashing, and we're going to talk a little bit more on that later, as well as Heidi Ridley, who founded RadiantESG Investors. We're excited to have her today. And Gloria Nelund, who launched TriLinc Global, that's focusing on private debt in emerging markets and in other places in the world, but with an ESG emphasis. I think what we want to do and what everyone here is excited about, to all of you panelists, is to tell a little bit about your firm, your strategy, and more importantly, how you got to where you are today. What was your path that got you here? Because as someone who does run their own business, you know, there are a lot of positives to that, but there are a lot of negatives as well. And it takes a certain impetus to persist in this endeavor. So I'm excited to hear a little bit about everyone's venture in this. Let's start with Heidi.
Sure, thank you, and thanks for having me. I'm delighted to be part of this amazing group. Gosh, where to start? I've been in the asset management industry for little more than 3 decades. I spent the last 18 years prior to this venture at a quantitative pioneer in investing called Rosenberg Equities. I was the CEO. I had a number of different roles over that period, but spent the last 3.5 years really leading the company globally. And we were one of the first quants to integrate ESG considerations. And so there's a bit of a theme there. But I decided to leave at really literally the beginning of the pandemic. So I announced that I was planning to go out on my own, I think on a Monday, and by the following week we were in lockdown. So that was a bit unexpected. We can cover that later, but I really just had a vision for the type of firm that I wanted to build and lead, and much of it was informed by Rosenberg. There were some very unique features that company had in terms of the diversity. We really benefited from that, really viewed that as being a powerful contributor to better decision making. And of course, having made the decision to integrate ESG into our core philosophy, I really thought that it was important to take that a step further. And so really kind of combining those two ideas with a very strong belief that having an inclusive culture, a culture that really is purpose-driven and can motivate and lead people, was something that I really thought would be an extreme differentiator in a market that's quite mature. A lot of asset management firms that have been around a long time, and you get a lot of embedded sort of behaviors and practices that aren't always innovative or nimble or forward thinking or frankly client focused. And so that was a very core part of the foundation that I wanted to build with Radiant. And so I decided to go out on my own and do it, having never wanted to be an entrepreneur, never thought I would be running my own company. I always loved leading within I guess the safety of a large organization, to be honest about it. But having had this vision and really a passion to see it through, it sort of just became a calling. And part of the foundational concept for RadiantESG is that we really view the concepts that are embedded in environmental, social, and governance issues as arguably the most important challenges that are going to be facing corporate behavior and capitalism in our lifetime. And we also see a growing focus on diversity, equity, and inclusion, or lack thereof, given shifting demographics that will accelerate as we see a generational transfer of wealth unfold. And so shareholder expectations and consumer preferences and regulatory pressures are going to continue to motivate and amplify these influences. We cannot get away from it. And I think that that's an opportunity. And it's an opportunity that if we approach the full breadth and heft of capital markets with an impact mindset, I think we can collectively play a really important and meaningful role in bringing about positive change. And so through Radiant, we plan to combine all of these elements that we really believe are critical to the future of investing. Bringing needed diversity to asset management, elevating ESG to its proper place within an investment process, and frankly doing our part to harness that power of capital to be industry advocates and really kind of drive positive change. And the reality is the world probably doesn't need another investment firm, but we think it needs a different kind of investment firm. And we're really fueled by the desire to build something the right way without compromise, and something we hope that will have lasting impact in the industry. And I think that means we need to break from tradition. So this is where the little bit of rebel in me comes out, but break from tradition and go beyond, beyond box ticking, beyond summary scores and generic approaches, beyond even what's happened in the past or even today, and to really drive positive change and deliver better outcomes for our clients. So we're a year and a half into it.
A concept that just for everyone listening, we're going to explore in more depth, which is how do you approach it and everyone's real approach to it. But I think a lot of people are also listening because they want to hear some more about your business. So we're going to let everyone introduce, then we'll talk about people's trajectory of their business, and then move into just the impact portion and how we're all measuring and how we're executing in that. Gloria, why don't you tell us a little bit about your company and your path to finding TriLinc and how things have been going?
Sure. So I actually spent my whole career on Wall Street with very, very large financial institutions. I'm much older than anybody here, so I started a long time ago. And I had been the CEO of Bank of America Capital Management. We were about a $35 billion global asset manager. So we managed funds all over the world for all types of clients. And then ultimately, I got recruited by Deutsche Bank to be the CEO of their private wealth management division for North America. And that was in late 2000 or maybe early 2001. And at the time that I got recruited there, Deutsche Bank had just been on an acquisition spree. And so they bought a whole bunch of asset management firms, and all of which that had private wealth management groups, but they had not integrated any of the private wealth management businesses. And so basically when I took over, we were operating with 5 different brands, with 5 different business models, basically serving the same client. And as a result, we were losing $130 million a year in that division. Yeah. And so this is a truth. Actually, one of the reasons I agreed to take the job is because I felt like you can only go up from there, right? There were so many problems.
That's usually when they bring in women to run things, is when
Yes.
they're like, oh, it's so bad now.
It's so bad.
Let's see what she can do. Yeah.
And that's exactly what happened. And I brought in a consultant and then, hired a management team. And in 3.5 years, we had orchestrated the most successful turnaround ever of a division at Deutsche Bank. And so we were, given a lot of career accolades, paid a lot of money. And in April of 2005, I had taken my management team to the Yale Club in New York to celebrate because we were hitting our 25% profit margin target. And walking home to my apartment that night, I just felt like, wow, is that it? I mean, you work really hard and you achieve something, and then there's this big letdown. And I couldn't really shake it. And so the next day, I just kept thinking about it. And I thought, I really want my life to have more meaning. I feel like I'm not doing enough for the world. And since I've had this awesome career and I've loved what I've done, maybe this is time to make a transition and find out, really what's my purpose in life and how can I make a difference? And so I retired at the end of 2005. And I obviously failed that, right? Because I have a company now, but I did spend 2 years traveling around the world, getting involved in causes I cared about as a philanthropist, because I thought, oh, that's how I can give my life meaning. And it turned out that as I was doing that, I realized I was not made to be that person, because I found aid in philanthropy very frustrating. And everywhere I went, I couldn't help but see investment opportunity. And so it truly was struggling. I call it my 2-year wilderness journey, because I was really struggling with what should I be doing to give back to the world. And in 2007, I was invited to London to join a think tank discussion group on the topic of how can we use capitalism to solve social problems. And for me, that was like the proverbial light bulb. I thought, wait, that is what we should be doing, because as investors, we have a lot of influence over how companies behave. And if we can just help investors realize that they have that power and then help them use that power to make a difference, then we really can change the world. And I spent about a year interviewing what were funds at that time in the market that is now called impact or sustainable investing. Back then, it didn't really have a label, and a lot was happening to organize the industry. So the Gen was getting formed, and IRIS came a couple of years later. The UNPRI had just launched, and what I found when I was interviewing companies, now keep in mind this was back in 2007, 2008, was that a lot of those firms were coming at it from an aid and philanthropy perspective. And so they were struggling to raise capital. And I was trying to help them understand, well, the reason is you need to understand investor behavior. And they're not going to invest in something if they think that it's concessionary, regardless of what a great impact it makes, because that would be something they'd put in their impact or in their philanthropy bucket. Nobody wanted to hear it. And so I felt like I was just beating my head against a wall. And so I thought, I'm just going to start a company and I'm going to prove that investors don't have to give up investment return to do good, but you have to have a real investment thesis, a real strategy, and then develop process and everything around the investment strategy. But you also have to have the same discipline around your ESG screening and your impact tracking and reporting. And so, I had the benefit of building that from the ground up. And much like Heidi, I had very definitive thoughts about what kind of a company I wanted to run, the kind of people I wanted to surround myself with. And so I launched TriLinc at the end of 2008. And then we didn't get our first fund launched actually until 2013. And that was a rough few years. You don't think of R&D when you're talking about asset management, but there really was a lot of that. But we launched our first fund as a public non-traded fund. In 2013, we raised $350 million in the public offering of that fund, which then gave us a track record to launch institutional funds. And so since 2013, we've invested about $1.5 billion in basically making loans to small, mid-sized businesses in very select developing economies. And we have not only generated nice returns for our investors, but we've also created a lot of impact in the communities where we've invested, both from our fund perspective, but also the companies that we've been able to support and the kinds of impacts that they've been able to also create. So it's been really fun to do what I love doing, but in a way that really makes it different. So.
Oh, that's wonderful. Oh, so thank you so much for sharing all of that with us, Gloria. Now we're on to Jillian McIntyre, who's just really launching her fund, even though she's doing aspects of it. So Jillian's launching a long-short equity fund. And one of the things she's emphasizing is highlighting greenwashing. So Jillian, everybody wants to hear about your path to that and how you're thinking of getting started.
Let's go. I'm so excited. Thanks so much for having me on this. I really appreciate it. But I am just so excited for the momentum that women are finally getting, that, we're finally getting the acknowledgement and, sort of the look, if you like, of great allocators and potential partners. So 221B Capital Partners is a equity long short fund. We're named after Sherlock Holmes for our sleuthing, if you like. So he was 221B Baker Street in London, where I grew up. So we are equity long short. Our philosophy is to focus on our core areas of technology and renewable energy that we do best, and we've been doing throughout our careers. So it's areas that we're expert in. And we basically take secular themes and we marry those with bottom-up fundamentals. So that's sort of very high level, essentially what we do. My path was no simple path, no simple journey. I grew up in the south of England in an area that lacked diversity, so I craved diversity. I also was blessed to be part of a very entrepreneurial family. So from the age of 7, grew up, my parents instilled in me the importance of work ethic and working very hard and supporting the family. So I did that from a very young age, and I really think it gave me a lot of tenacity and grit that I think you really need to set up your own business. So I started my career in finance in the early 90s at Morgan Stanley in London. Was one of 2 technology research analysts. I reported to a woman who was just incredible. She was she was the Mary Meeker, if you like, of Europe. She was very, very tough, but gave me, she was just a fantastic mentor. As I progressed, most of the tech team of Morgan Stanley moved over to Merrill Lynch. That's what brought me to the United States. So I landed in Boston, carried on, again, focusing on technology, but we had MIT, so I had the academic angle. I was able to interface with private equity, with VCs, just really broaden not only the universe of companies that I had access to, but also just the types of people that I was interfacing with. I knew no one when I came here. So for me, it was really up to me to build my network. I segued into the buy side after the boom and bust period of 2000. My view was that the sell side researcher was really challenged. There was a lot of conflicts because everyone was doing banking at the same time. So that led the credibility of the sell side research began to diminish. And I think that's when commissions peaked for a lot of banks at that time before they've obviously come back again. But so I've had the absolute honor and privilege to work for some of the most amazing hedge fund managers on a global basis. So Art Sandberg was where I started my buy-side career, who was the founder of Pequot Capital. I was hired by Chris Hahn of the Children's Fund, the activist fund in Europe, to run his short selling process. He is one of the most brilliant investors, and I continue to have a dialogue with him. He's just a phenomenal investor, more so on the long side. So that was an interesting, we can get into that later, that was an interesting mandate to have. I joined White Elm in 2012, which was a little bit more of kind of what I do, which is sort of mid to large cap companies, again, in technology, renewable energy. But that was about growing the business. So we were 300 million in a couple of years. We got to about 1.4 billion. And what I learned from that experience is it really is about what I call the 3 Ps, which is the people. So, a lot of what Heidi and Gloria have already said has resonated very well, in that I think that the hedge fund industry, unfortunately, has a dreadful culture in general. And it doesn't allow people to really express themselves. It's more of a fear culture than it is, allowing people to really, again, express their abilities. And so I was always determined that I wanted my own culture, my own business. So that was like one of the biggest reasons. And frankly, I just believe in what we are doing and what we're capable of doing in terms of stock selection, the way we think about our sectors, and how differentiated we are. And I call that more cognitive diversity. We always look at things differently from our peers. So I think that that's been sort of one of the biggest learning lessons, if you like, along the way. And so, as you rightly said, sort of we are pre-launch, and we have been in the process of marketing through Goldman Sachs and Morgan Stanley, who've been incredibly helpful and supportive. We've got some great lead investors, very well known in the industry. And so really excited and looking forward to launching.
That's exciting. I'm looking forward to the launch as well and hearing more about that.
Thank you.
And I'm going to ask like a few rapid fire questions now, right? So let's start with Gloria. What was the biggest help and the biggest hindrance you faced as you started your business?
Yeah, the biggest help was, I think there was a couple. One was that at the beginning, I was using my own money to launch it, to fund it. And so I was able to do things the way I wanted and make decisions the way I wanted to make them. And I was able to hire amazing, amazing people that, worked alongside me, became partners. And so I do still today have a really small group of people who helped me build it. And I would say that was truly the biggest help. Interestingly, the biggest hindrance for me was I don't know what to call it, but what I thought would be helpful industry people, like people who we all had the same goals, or at least I thought. I found that they were the most critical and sort of my biggest detractors, which I found extremely frustrating because, I thought, wait a minute, I'm really truly trying to do something good and just trying to be helpful. I'm not, this Wall Street person, which is, that's coming in to just take advantage. And it was really a challenge. I would say that has now changed. I mean, it's been more than 10 years and the industry has really developed and people are being more supportive, but things like we wanted to support all of the industry things that were going on. So we, became a founding member of the GIN and we started using Iris the minute that got launched. We are a B Corp. We were like trying to be supportive of building the industry. But there was a lot of resistance. So I would say that was my biggest hindrance and it was frustrating.
Yeah, I think just to toss in a comment around that and then we'll hear from Heidi and Jillian on this. But what I think is that in our space of, women and minorities trying to start established funds, everyone seems to think there's only enough space for one. So we tend to compete against each other.
Right.
Just say, look, I'm just going to do my thing. And, I think that I'm passionate, you said, Heidi, about it. And I want to do this because of my own reasons. And it's interesting that I think the most pushback women and minorities get are from their own group. And the lack of support really comes from
And you just reminded me, the other big thing that happened was when I did ultimately need to raise capital around launching our public fund, I had to go raise some outside equity in the company. Right. And it was really interesting because, I was doing projections that I thought were just realistic. And I remember meeting with someone who was in a private equity firm, actually a venture capital firm, and it was a woman. And she said, I have to tell you, you're really going to struggle getting any kind of capital with these numbers because what happens is they automatically get discounted. And so discounting your numbers, which you think are realistic, are going to put you well below anybody's target. And so you're going to have to mark them up so that when you get discounted, they're probably back to this number. And I was like, what? Like, that doesn't even make sense to me.
Well, I also would say that, I don't want to get, like kind of sexist here, but men tend to exaggerate their expected return and women come in at an appropriate level. And so there's two ways that's just this cognitive dissonance in the way
it's true.
Two groups typically, not all, but many people approach it. All right, Heidi, sorry. Talk about your biggest help and hindrance.
Yeah, I'm getting whiplash over here, nodding my head. if I may, I mean, I would start with hindrance, help, hindrance, help. You know, the hindrance at the get-go was that I really had, you know, this vision. I felt like I could have turned the company I was already running into this, and it would have been a $20 billion startup. And the hindrance was they literally couldn't bend their brains around it. And to Gloria's point, I also had the comment, because for me, I'd rather surprise on the upside. So I'm going to be very practical, very realistic in the building of the budget. I've run a business. You know, these numbers aren't new to me. And I found that it was very, very true. And there's a TED Talk about this as well, where they did actual studies of VC women pitching, and literally the biggest hindrance is women, by and large, get asked all the reasons that the thing can go sideways.
Right.
What risks are embedded, what's going to go wrong, why would this even make sense? Whereas typically when men are presenting, it's what's the opportunity. And we, you know, we had another team that had presented extremely aggressive, you know, frankly, in my opinion, unrealistic figures. And I was told, even after they had not delivered, I was told that my numbers needed to look more like that in order for it to be compelling. So that was the hindrance. The help was, I decided I got to go do this on my own. And what I found, you know, my prior job was very all-consuming because we were really trying to rebuild, and I had very little time to be networking with amazing people like this. So when I came out of it, and that's all I had time to do, it was incredibly humbling and encouraging, the community that was just rallying around us. You know, I was very fortunate that my partner and co-founder is someone I worked with for 20 years and I greatly respect. We have very complementary skill sets, so the fact that she decided to take the leap with me was already huge. But we both found that every conversation we had, someone connected us to somebody else, and they just were rooting for us, and that was huge. So then we started having conversations with strategic partners, because I always knew going into it that we needed to have a strategic partner. We needed to be willing to part with some equity to have that backing, that was super important. And what we found was that we were targeting firms that didn't have diversity, didn't have ESG, because for me, part of my pitch was it's asymmetric risk. If you know, give us the capital and back us, worst case scenario, if we never deliver from, you know, the revenue generation, you know, building, at least you've paid for and built an incredible ESG capability that you can utilize in other ways with a very strong team. And what we actually found was that was the wrong way to go about it, because to a person, and we talked to probably 10 or 11 credible firms, and they were, you know, one thing was they validated our approach to ESG. They were very impressed with our credentials and all of that. But it at the end of the day would come down to, but why does it have to be women owned? Why do you have to have your own brand? Why can't you just join us as a team? You know, why can't you just be with, and then you'd get the proverbial, well, good luck with that. And you kind of knew secretly they were hoping you didn't do well, so you would have to join them as a team. So that was the hindrance. And then the help, again, was that, you know, that frustration led me to vent to someone I know and respect in the industry for many, many years, who happens to be the CEO of HSBC Asset Management.
Wow.
And, you know, and he was like, well, why don't you know, have an initial conversation with our team? And that conversation led into, you know, a due diligence effort that made them our strategic partner. And, you know, I mean, I couldn't have asked for a better organization with a brand and their own, you know, sort of commitment to sustainability and diversity and inclusion. So in hindsight, we found philosophical alignment out the gate. And I thought, wow, I just wasted a year, you know, talking to the wrong philosophical, and there's nothing wrong. Those firms are credible. The people were lovely that we talked to. It's just, they're so set in the more traditional realm that they just couldn't, you know, often it was like, well, if we do this with you, what about the rest of our teams? They're all going to want to go out on it. Like there was just always this Pandora's box kind of thing. And so anyway, so there was, we had this kind of, you know, up and down a bit journey to land where we did, which was the perfect place for us. So I mean, I wouldn't have done it differently, but I have to say I felt like we could have launched a year earlier had I known going into it, if that makes sense.
Oh, I mean, I think a year for some of us older women, that's pretty good there. Jillian, you want to tell us a little bit about your how what has hindered or helped you along the way?
Sure. So I think one of the things that's really important is to find your voice and to really ask for what you want. You know, be direct. I know that Bill Ackman, who I've worked with on the Pershing Square Challenge for the past 5 years, you know, has always said you got to be direct. So I called him up and said, okay, can you write me a check? Right. And there was a very long silence on the phone. And but the response, which became a help, was, okay, this is what you should do. Okay, 1, 2, 3. These are the steps that you should take. This is how I can be helpful to you. So it was by asking that I actually found the help, right? So I think that it's really important to find your voice and to not be afraid to ask for help. And I think that leads also to the right people, the right sort of partners and the right people to have surrounding you. Because they're also the people that can tell you what you're great at and what you're not so good at. So, you know, my business partner, who I've known since 2002, he was a phenomenal individual. He's extremely talented on the operational side, and he's a great stock picker also. But he's also someone who said, Jillian, you're a great short seller, but you're actually really, really good on the long side as well. So, you know, I had tried to pitch myself as a short biased fund in my first iteration of 221B. And what I found was that there just weren't the mandates for that strategy. And it was just really, really hard to scale. But it's also having somebody who is able to sort of, who knows you. So it really is about, you know, having the help is having the right people around you.
I think that's so true. So what I think is interesting is, and this is probably more relevant right now to Gloria and Heidi, but Jillian, you may have some insights as well to this. You know, COVID has fundamentally changed, in my mind, how people do their businesses, right? So I'd like to hear you guys talk and address a little bit specifically about what's your view of how COVID has helped or changed the way you do business, and is it a good thing? Is it a bad thing? Is it a blend? Let's start with Heidi on that one.
Yeah, I mean, just coming at it from a simple work perspective and not the broader existential, you know, issues that have presented themselves. I would say that as just looking at the industry, a couple of observations of COVID and the pandemic, and we actually wrote a paper about that really being the tipping point for what we view as a paradigm shift to a stakeholder mindset. And I think what the pandemic really unveiled in a huge way is how interconnected we all are. And, you know, there's no kind of separating what's happening in the environment from, you know, how people interact with one another, to society overall, to the economy, so on and so forth. And I think relatedly, it also showed us that we can, you know, pivot and move and change and do when our backs are against the wall. And so, you know, you have a lot of firms that up until that point, and frankly, Rosenberg was not one of them, we had always embraced more of a flexible orientation toward work. We had a very robust infrastructure, obviously being a quant where people could work and connect from really any place. We had a global company that felt like one team because of that. And so for us, it was not difficult. But what you had going into it was a lot of firms who really resisted, you know, we need the FaceTime, everyone has to be in the office, so on and so forth. And then when we were faced with it, guess what? A lot of firms actually not only survived, they thrived because they had to make the changes and So what I'm always perplexed by is I feel like I still run across a lot of leaders in the industry who can't wait for it to go back to the, I can't wait for this to be over so we can go back to the way we were doing things. Well, there's no going back to the way we were really doing things. And instead, I think we need to embrace this as an opportunity to see the positive and, what we can achieve with a more open mindset than, we operate in this way because that's the way we've always sort of done it. And so I think that there's, in my mind, the pandemic, what it really brought to the fore was how important it is for us to think holistically, to think about how our actions, intended or not, can have an impact, and how to channel that in more positive ways. And I think so I really hope that we take that learning forward, even after, we don't have masks anymore and we don't have to watch COVID stats every single day. And so that's really my hope. I think personally for us, the challenge was we didn't expect to be launching going into a pandemic. And so, it took us a year longer because we were certainly wondering if we were ever going to find a strategic partner who'd be willing to back us via Zoom. We're so used to meeting people face to face. Incidentally, one thing that I find very interesting about the whole Zoom thing is you're not meeting people face to face. And so there was that challenge, but at the same time, there's an interesting intimacy to Zoom that I found that, when I met people, sometimes the type of interaction I would have with them would have taken 3 or 4. You're talking to someone and their little daughter toddles into the room, or, their dog comes up, or you just start to get to know people outside of their business persona. And I think that that's also an opportunity that people should think about a little bit more closely. It's certainly harder to connect, especially when you've got new employees that you're trying to bring into the culture but if you work at it, it's not that hard. If you really think about how you can do it and how you can achieve it. I know a lot of firms that have done it and done it very well, including onboarding new employees. But so anyway, my observation is, there's a lot of challenges that the pandemic has brought forth, but at the same time, it's presented opportunities, and we shouldn't lose sight of that. And I think we should cling to the opportunities and learn from the challenges.
Thanks, that's great. Gloria, you are focusing in emerging markets. Yeah. COVID has really presented interesting
challenges.
Can you talk to that a bit?
Sure. So, not unlike Heidi, we viewed the challenges as both challenges and opportunities. The great thing, just like she said about Zoom, is it can connect you to a lot more people more efficiently. And so one of the things that we do is we have these deal partners, deal origination partners all over the world in the markets where we're investing, and they're the ones who bring us deals. And we do a lot of due diligence on them before we agree to partner with them and look at their deals. And we would always annually at least be on the ground in that market with them, as well as visiting our investee companies. And obviously during COVID, we couldn't do that. And so we had to do it on Zoom, which was harder. However, we did find that we could involve more people on our team, because if we're going to South Africa, we're taking just a couple of people. We're not taking our operations people, our finance people, our compliance people. But in a Zoom environment, we could structure a whole agenda where it involved our whole team, and they got to know people at these partners that they would not have otherwise gotten to meet, right? So there were some terrific opportunities from that perspective. It was hard not being able to go see our borrower companies, but because we have these partners on the ground, we actually had to involve them more in helping us with that follow-up. And we have great partners, so that worked out fine. From an employee perspective, I would say that's been the biggest challenge. So most of our team, not all of our team, but most of our team went remote, like everybody did in the middle of March of whatever, 2020, I guess. And our team is a very, very close team. Our culture is very family oriented, very, very connected. And we had to do a lot of extra things to try to keep everybody connected, because you could literally see people like disengaging a little. And there were a couple of people that we actually had to bring back to the office sooner than everybody else, because we could see that it was just not a good environment for them. So we took a lot of effort, I would say, on our part to really keep, in touch with everybody. And then when we went to bring people back, I think this is not unlike lots of people's experience. Everybody felt like you were taking something away from them, and they want to keep this flexible arrangement of work from home whenever they feel like it, and we're like, well, wait a minute, our business doesn't function as well when people are remote. And so we are working to still find a solution. I don't think we have the answer, but for us and the way our business functions, it functions better when people are here and working together on things. And we do have individual jobs that are fine remote, but for the majority of our staff, that's not true. And so we're just trying to find that balance so that we can also keep people and keep them motivated. From an investor perspective, the biggest challenge that we had was the institutional investors. And when I say that, I mean the ones that are consultant driven. They, during the pandemic, basically were not hiring managers that they had never worked with before, because they couldn't get out and do diligence. And so we found that a real struggle, because we were far along in a lot of opportunities, and then COVID hit, and then everything got put on hold. Then we were strung along for a while, and then all of a sudden they were like, well, we just can't hire anybody, we don't know. And so for 2 years, that side of our fundraising was a struggle. Now it's picked back up, and things are moving again, but we were impacted in a lot of different ways. But I do think there's great things that have come out of it, like Zoom, for example, right? And you can, not that we're going to replace everything with it, because I don't think we should, but there are certain, meetings and stuff, like even this, right? We have the opportunity to talk to a lot of people, and we're calling in from all different places. And I think it creates some opportunity that wasn't there before. And then, how easy it is to get food delivered is.
And good food, right? Not
food.
That's a real development there. Jillian, you're trying to start up a whole new business. How are you doing your team, and how is that working during the last 2 years?
Sure. So we're going to be 4 people day one. We have great communication anyway, so that really hasn't changed or at all. I would say that the challenge, if anything, is getting out to see folks. So we interact with a lot of private companies. We go to a lot of events, a lot of conferences that are more industry conferences. So we tend to go to places that most of our peers don't go to. And so getting out amongst that has obviously had its challenges. So, I would say that with respect to, management teams of big companies, I mean, just listening to conference calls or like the earnings calls or reading the transcripts is really enough for us. We sort of like to get more into the weeds of, the process, the operational side, the model, the financial model, etc. So yeah, so not overly impacted. I would say the one thing I'm quite diligent on, if I can, is making sure that I'm taking breaks, short breaks, but sort of that's the one challenge, right? Working remotely is that, it can be 24/7. It is 24/7, but I think it's important to have mindfulness and to have those small breaks in between, so that you get a sort of somewhat of a rest, or, you lean on other people within the team to get something finished, or, what have you. But I just would add that too.
Great. So you talked a little bit about this, Gloria. So I'm going to ask for some input from Heidi and Jillian to see, what they think about this. When you're trying to get in front, aside from the COVID world where nobody wanted to hire any new managers, how are you finding it getting in front of consultants or family offices? I think a lot of people listening would like to hear a little bit about how that process has been for you starting your firms, and has it been easy? Has it been hard? I know you talked a little bit about your seed, Heidi, being difficult, but can you talk about, now that you're up and running, how has it been getting traction with these groups for allocations?
Sure. So we started out with really looking for a strategic partner that could effectively give us the capital to bring on the rest of the team and build the full investment capability, but also sufficient capital to build the business the right way and have the runway and the patience to build a long-term enduring business. We just did not, knowing that our industry is very typically falls back to, come back to me when you have a 3-year track record and over 100 million in AUM, which is interesting how you get there if no one's willing to be the first person to step up to the plate. But we just assumed, it could take us 3 years to get the very first client. And so we really wanted to make sure we didn't have a situation where our backs against the wall, we had to cut corners. So that was step one. But we officially launched at the end of the year. We personally seeded our own portfolio to get a track record going. And so we started doing our first meetings. Actually, International Women's Day was our very
great.
It wasn't planned that way. It just, I woke up and I thought, oh, this is kind of ironic. And so we had great meetings in Boston and New York, and we found that people were fairly receptive to meeting with us and hearing our story. It was challenging because, to Gloria's point, I think people are still straddling the fence in many places around, coming back to work versus work from home. And so there was, for example, we were in Boston, but we ended up meeting with a consultant that's there via Zoom the next week because they were not quite, back into the office. But so far we've found great receptivity. I did my first trip to London since the pandemic. And I used to probably be in London about every 6 to 8 weeks for 3 years straight. So that was an exciting opportunity for me to go back on a personal level. But what we found was real bottom-up interest from clients reaching out and wanting to actually hear from us, learn about our story. So on that side, it's been very positive. I would say that, in most cases, they've been very engaged, very interested. I think our story and our approach is resonating and feeling differentiated, but I think we've got, 2 challenges. One is the one you would expect, which is, this sounds great, but it's early days. So, just keep us posted. And that could be anywhere from 12 to minimum 18 months track record. So, it's a process. I would say the other challenge, for us is we're in listed equities, and it definitely more and more focus, it seems, is currently search activity is placed on alternatives. And so that, that may be a bit of a roadblock for us in the short term. But, we're playing a long game, but it definitely seems like a lot of the focus is more on alternatives, real estate, things like that. And so we've got those kind of 2 headwinds, one being a newer manager, and then the other is just where the search activity happens to be.
Right. Jillian, how about yourself as you're launching? And
Sure. Yeah. And Heidi's comments definitely resonate, as a new manager for sure. But I think we've been pretty lucky. We've gotten in front of some great firms and great potential partners. I'm really, really excited about, who we have that have indicated that they'll come into the fund pretty early on. So that's really, really exciting. And I think the other thing is that our strategy really plays into the strengths of the current sort of the market, the current market conditions, right? Because what we focus on, and I think one of the challenges in the marketplace is just this, concentration And if you were to look at our portfolio, we're made up of a lot of idiosyncratic names that are very different. We're not a Me Too portfolio. So I think that has definitely caught the attention of a lot of folks. You know, and I also go back to what I said at the start, is I think the momentum around minority funds and women-run funds is very, very strong. So I'm really excited about that. But we've been lucky. The last conference, we just did an emerging managers conference in Orlando, and we had 155 allocators signed up over 3 days. So it's just really strong demand, which is great.
That's wonderful. And Gloria, you have anything to add to getting in front of family offices? I mean, it seems to me your product would really be perfect for them. So
I would think so. We've really struggled with that. We have 2 family offices that are very involved with us, with our firm, but we've really struggled to get in front of you know, family offices who really are interested. And I don't know why. We obviously are doing something wrong. So because you would think it would be good for them, but I don't know. We've struggled.
And have you tried in London? Because usually they're a little more receptive to impact investing. I
Yeah, and so we hired a placement agent in London because we don't really, you know, have those contacts, and we've not had success. This is our 2nd placement agent, and again, we might just be hiring the wrong people, but we thought that too. We were like, wait, you know, Europe is probably our better bet because of, you know, they're further ahead from an ESG and impact perspective. And, you know, even emerging markets isn't as scary for them. They're much more used to a global world than we are as Americans. And so, you know, I still think there's great opportunity there. We just don't know how to tap it. So.
Sorry, can I interject actually? Gloria, is it maybe a function? I think I read a Jefferies report that said there was something like $500 billion of capital that came into ESG related funds last year. So is it a function of those funds are being absorbed? And I think that, I mean, Barron's had an article on, you know, ESG performance, not, you know, I'm talking broadly, right?
Yeah.
Had been very, very challenging. So I just wonder if it's a function of those 2 things.
Yeah, it could be.
Yeah.
It could be.
Well, I think it's something else. And I think it's time now to get to this topic, which is how do you measure what you're defining as ESG? And we see a lot of passive product come out that's ESG, and then you pull up the mutual fund or the ETF and you see it's just tech.
Yeah.
Okay. And therefore it's had great performance and it's ESG labeled and has good ratings from Sustainalytics and from many of the Morningstar metrics. So, and then it really isn't ESG, not if you're trying to really adhere to the precepts of that approach, that ethos. So I'd like each of you to talk to that topic of why is your approach much more real when it comes to that than some of these others? And why don't we start with you, Gloria?
That'd be great. I appreciate that because I tied to Europe. We actually qualify under the SDFR new rules, right? We are I think is it Title 9? Is that what they're calling them? Like the levels, article, sorry. We actually are at Article 9. We're like the highest ranking from an ESG perspective because we have a whole ESGMS management program that we adopted that matches what the IFC does. It's actually a little bit even deeper than theirs. And I don't mean their exclusion list. I mean their actual environmental, social governance plan. And so they even reviewed it for us and said, wow, you guys go even a little bit further than we do. So now we have the advantage of we're dealing with private companies. So, you know, we can go deeper and look at what actually are their policies, what are their practices, what certifications do they have? And then if we think that there's any ESG kind of risk, then we actually will hire a third party that's on the ground to do an analysis or make sure they have an ESG MS plan in place or an ENS plan in place. And so from an ESG perspective, we go really deep. Even from an impact perspective, we go really deep. And then we do all of our reporting, we do all of our assessments on an annual basis, and then we report them out annually in an annual sustainability and impact report that we then get reviewed by an auditor who does an assurance test, an assurance report. And ours just came out like, gosh, for 2021, it just got published about 3 weeks ago.
Great. That sounds like an excellent process that any consultant should love. So
yes, they should.
Yes. Heidi, why don't you talk? You've got the algorithm there, and so how are you approaching this conundrum?
Yeah, I mean, I think, to your point, the vast majority of ESG products out there are really primarily sort of indexed with a tilt. So usually exclusions driven. So, taking a broad-based portfolio and using something like MSCI scores to screen out, bad actors, if you will, on ESG, maybe upweight, some of the better ESG names. But to me, I call that a sleep at night portfolio. So it gives you the impression that you're changing things, but really you just have a better MSCI score than the benchmark in that portfolio. And so I think that is a big challenge. And I do think the sophistication is rising when it comes to ESG, and we certainly welcome that. Our approach is very, very different. We philosophically, as I said at the outset, believe that environmental, social, and governance issues, each being their own thing, not combined into one number for companies, are going to have profound effects on our companies that we invest in over the long term. And so as prudent investors, it's very important for us to not only understand the fundamental underpinnings of a company, but also the threats and opportunities that company faces with regard to its environmental, social, and governance practices and the ecosystem, in which it operates. And so we've built I guess we'd call it maybe a data platform that really has an ESG mosaic, is what we call it, approach. And what that entails is it's really multi-source. So we don't just use MSCI or ISS. We use as many different sources to get at this information as possible, including NGOs, including using natural language processing on news and information. So we want, the breadth of information that we can get, and we don't use summary scores. All of the information we use from whatever data sets is always granular, because the summary scores also have embedded in them opinion data about materiality and things like that. And they approach it differently than we would. So for example, a lot of the summary scores, if they don't have a measure for a company, they'll use an average. And I don't think we can guarantee that company is average if it doesn't have any sort of reporting. And so we try to have our own, given we've got a very strong and long quantitative background, we have our own approach to how we handle that. So, it's multi-source, and importantly, it's multi-concept. And by that, I mean that most of the ESG scores and focus out there, but there are some specialists, but the vast majority are really anchored on how a company operates. So what kind of, carbon footprint, water usage, waste, so on and so forth, to come up with their scoring mechanism. And obviously that's important. But what's equally important is what goods and services does the company produce? Where is it physically located? Does that present certain risks given climate change? How does the company interact with its supply chain? What about norms-based information, controversies? So there's, there's a myriad number of things we could be considering about a company that fall under environmental, social, and governance, categorizations that go far beyond how a company operates its business. And then finally, it's multidimensional. So again, back to the scores, they're very much sort of point in time, perhaps historical, depending on how long the data provider has been around, which again is important. We are much more interested in where the company is headed. As investors, we're in the business of forecasting the future. And so we're really interested in what's the evolution of the company. And importantly, we think that that's where the opportunity is in the companies that are working hard to transition, that are leading the way. And again, this is another reason why we are kind of against philosophically simply having an exclusions-based approach, because some of the companies that are the heaviest polluters yesterday, today, are the ones investing most in a transition to a green economy. So I think that, for us, we really think about it very holistically. It's a much more sophisticated approach, that the intent of which is to get to what investment insight is this information bringing to the table. Not so much, and that the output, and I think, Susan, you touched on this, on the reporting side and how we can demonstrate is really around real KPIs. So what have our investments, what do we expect our investments to bring about? What is the overall carbon footprint of the portfolio? How is this company demonstrated that it's increasing its diversity, that it's improving its safety practices and its governance? And really talking in those terms more than my MSCI, my portfolio is an MSCI of A versus the benchmark of BBB. Like, who cares? That doesn't mean anything. And so really kind of looking at the investments individually and being able to articulate why that company scores well, if you will, along ESG metrics. Why do we think it's a leader, which is something that we're looking for, an evolver, which are these transition companies, or an impact company, a company that by nature of the goods and services it produces is creating impact in the world. And so that's sort of how we approach each ESG. And it is pretty different, and it requires some explanation, but I think that it's resonating pretty well. And the last thing I'll add is one proprietary feature that we've also built into our assessment, and I think it's germane to the greenwashing comment that I'm sure that Jillian will comment on, is that, today you have the world and his wife has all gone out there, we're going to be net zero, we've signed up to the biodiversity pledge, we're going to hire all these women and minorities, and it's all going to be great. And so we've built a proprietary assessment of what we call credible intent, which is around how believable are, our company's claims. And it has multiple layers. I think the first is ambition. At least you've set a stake in the ground. You've communicated it. You've committed to doing something. But what we really want to understand is, are there targets set against that? Is there accountability? Is there compensation tied to that accountability? And where we see kind of the best of the best would be, you've actually got CapEx. You're actually directing budget toward these outcomes. And so that I think will be an increasingly important feature, because just as funds and products and asset management firms greenwash, I think you're going to see that pressure kind of trickle down, and you'll see more and more companies feeling the need to say that they embrace X, Y, and Z. And we as investors need to understand whether we think that that's actually going to transpire, if that makes sense.
Yeah, thank you. Jillian, you're on with the greenwashing. So.
With the greenwashing. Actually, I love the comment that Heidi made about the credible intent, because it really does. So the way we think about ESG is we believe that the governance is, we're ESG aware, but we believe that the governance is by far the most important part of ESG, right? And so, looking back at what a company has said they're going to do versus what actually transpires is part of the case study process that we do. So when we do our case studies on our companies, whether they're long or short, it is looking back at both the culture, but also what the company specifically says versus what they do. So I love that expression of credible intent. Our perspective is, it's understanding, the management team and sort of what what they're telling us versus what they're not. And what I mean, because and what I mean by that essentially is, I'll give an example, shall I? So one company that we've presented as a short, which doesn't necessarily fit into the environmental or the social aspect, but it's more the governance example of the governance angle, is Carvana, ticker is CVNA. So Carvana is, I think, has been a consensus long. It's a company that sells cars online, and they came up with a very genius sort of model at the outset, right? But again, this is sort of where managements can go awry. So Carvana has actually, through the Freedom of Information Act information that we've found, has had an undisclosed SEC investigation since August of 2020. And since that time, the management team has sold $3.5 billion worth of stock. That's an extraordinary amount of stock in a fairly short space of time. So that's, for us, that's a problem, right? So secondly, what's the driver behind that SEC investigation? It's twofold. One is the self-dealings between the management, meaning the chairman and the chairman's son's business, or it could be down to the model, which is loaning capital to the buyers of the cars, but it's in the way they account for it. So this is a company that sort of falls into our theme we call profitability versus Ponzi growth, right? This is a company that's not made money, keeps coming back to the capital markets. It's now pivoted its model, and we think that there's a real case here of potential bankruptcy. And this is a company that has been a consensus long for some years. So I think that, that is one example where governance is really, really important. On the environmental side, we do spend a lot of time on renewable energy, and we are very pro sort of move towards net zero and investing in any companies that are going to sort of help that. But again, it's in the representation that these companies make to investors. One company that I presented to Jillian Robertson was SunEdison, which was a commercial solar company in 2015, and it had misrepresented itself to investors, and within about 6 months of the pitch, it was bankrupt. But here's a company that falls into, they're doing good, they're helping with net zero and helping with climate change, but the reality is that, it was a very complex structure that was built to deceive investors. And it was very, very well done. And the only way that you could really uncover that was if you understood the credit angle of what they were doing. So I think that there are great companies out there, and we find great longs, but with respect to ESG, governance is by far the area that we'll focus on. Oh, you're mute. I think you're muted.
Again. All right, there you go. I think all of these are really great ways of approaching it. One thing we haven't talked a lot about is how are you modeling out, or how are you considering and thinking about a diversity, equity, and inclusion? One thing we found, at least in working with our endowments and foundations, is that's really viewed as a separate topic by them. So they want to hear about both the ESG, but they don't want really DEI to fall under social anymore. They want it as a separate topic, and they want you to address it specifically. So we are tracking that when we allocate to managers in a very specific way. So I just wanted you guys to speak a little bit to that topic, and how are you approaching it as you look at portfolios? Gloria?
Yeah, so interestingly enough, as a firm, we have always been extremely diverse, and it wasn't really like by design, it wasn't intentional. But in fact, one of the institutional sales guys joined us a few years ago and said, why don't you position yourselves as a women-owned business and a women-led company that's really diverse. And I said, well, because I just never thought to do that, because we aren't that way because of this, focus on DEI. That is what we believe. And so we are a very, very inclusive company that happens to have a lot of women and minorities. And now I would say we are seeing way more interest in that from institutional investors. And so we are focused on that. We're now getting our certification and doing all the things that they would want to see. And you're right, Susan, they do separate it from ESG, absolutely. From our investee companies, it's interesting because we were tracking percent of female employees, percent of female owners, management, people in management, what were their policies around women. And it wasn't necessarily, well, the policies were part of our ESG screen, but this, how many women do you have and everything, have never really been part of our ESG screen. We were doing it because we wanted to start building a database of, companies in different regions of the world and countries so that we could have some kind of a baseline over time. And now, as it's getting more attention, we have the data to be able to report it, even though it hasn't been a lens through which we invest, but it is definitely something that we look at.
Great, thank you. Thanks for sharing that. And Heidi, how are you guys approaching in your modeling?
Yeah, we definitely look at that. I don't know if we would necessarily equate it specifically under the S umbrella. I agree with you that there needs to be a broader perspective. I mean, just even in the starting of our own business, we really see diversity as and paired with real inclusion, because that's an important point. Is I think so many firms are now relegating, we need more diversity, we need a chief diversity officer, we need to hire women and minorities, but they do nothing to look at why they're not diverse to begin with. So kind of looking at the cultural ecosystem. And so, we do think inclusion is how you extract the benefits of having diverse perspectives at the table. And importantly, we see that as the remedy to groupthink. I mean, bottom line, that is, within any business, I think the challenge at hand is staying relevant, being able to innovate, use resources wisely. And groupthink is one of the most, in our opinion, value destroying practices for businesses today. So diversity and inclusion really has the power to break through groupthink to lead to better and different ways of working. And certainly I've seen that in practice. And so we primarily see that coming through and being very germane to how I use those pillars before that I talked about, but how a company operates. So it's operational strength. And so some of the things that we look at in our investment process is people in leadership. So, who are the company leaders? What level of diversity exists amongst the most senior members of the firm? Because, it's really about the decision making. I think it's great that there's diversity across the whole organization, especially if an organization is typically promoting from within, but we really need to see that diversity where the decisions are being made. And this should go well beyond board level to include senior management when we can find it, because of course, finding data is often very challenging. And also, to be clear, when we talk about diversity, again, in our own business, as well as what we scrutinize, we push to include as many dimensions as possible beyond gender, to include ethnicity, sexual orientation, native language, age, as much intersectionality as possible. We want to look at the firm's culture and statements about inclusion, hard to get at, and credible intent is one of those ways that we try to get there. And simply hearing senior leaders talk about diversity and inclusion as priorities and not relegating it simply to the HR team. The second would be the employees, like I said, throughout the firm. Who do we see in the pipeline at every level within the firm? Policies and programs that are aimed at not just recruiting diversity, but again, developing talent and promoting it. Another area would be supply chain. Does the company, have its own D&I requirement for vendors as we do? And is it subject to D&I expectations from its customers? And then I'd say probably finally, well, there's a couple, but there's lobbying, political contributions. It's a bit controversial and maybe more relevant in the US, but does the company lobby for or against policies that could affect diversity within the workforce? Lending and insurance, again, a bit hard to find that information, but we've learned a lot about financial services commitment to diversity when we understand its willingness to push capital toward the hands of diverse decision makers. And then probably the last place would be policies. So, does the firm have policies in place that will work to foster greater inclusion? And other concrete examples would be protections against on-the-job harassment, even protections against workforce violence, programs that support maternity and paternity leave, formal mentoring in the US, voluntary release of EEO1 data, which is something we're really big on. And so, just simply reporting on diversity data, it's incredible how much resistance there is to do that. And so those are kind of a few different ways that we try to think about diversity as it relates to how we assess investments in our portfolio.
Very, very, very inclusive approach. I mean, there could be resistance to reporting because it's just another report to fill out. I mean, it is a lot to ask companies to do. And this kind of gets to another topic that we have, I think, a time to address is everyone here is running a small business right now. And what do you think about that? And as a final question, as a challenge going forward, what is the headwind to being a smaller business that you've seen, and what do you think is the tailwind as it relates to your strategy and to what's happening in the world ahead of us, as much as we can see of it? Let's start with Jillian.
Yeah, it's a great question. I mean, for us, look, our focus is on performance, right? So as we think about launching the fund, we're not asset gatherers. So our strategy and our goal is to make sure that we focus on performance first. With our strategy, we think we can scale it to about $3 billion on average. The market cap is between about 25 to 30 billion on the long and the short side. So that, we definitely have the ability to scale it, but I think performance is our focus. So to that end, we don't really have challenges so much. The most important, the other factor is just making sure we can de-risk the business. So having a line of sight of assets coming into the firm is very important. And that's really why we focused more on marketing first, then launching, and then, hopefully sort of soft closing so that we can, again, focus. I strongly believe that, taking in capital is a responsibility, and a commitment.
Great, thank you. Heidi, what do you see as a headwind or a tailwind?
I think the headwinds are hopefully a continued greater focus on diversity and having an ability to assess and support diverse owned managers in all asset classes. And I think that's I'll come back, that'll be a tailwind, so I'll come back to that. But I think a greater focus on that. We are seeing more endowments and foundations and frankly, consultants paying a closer attention to that, really trying to assess the commitments to diversity and seeing that as an important feature to consider. I also think that the other, that was a tailwind. I'm working backwards. So the tailwind is that I think the other tailwind is on the ESG side is really growing sophistication around thinking about ESG and how it really factors into investments and what the real economy outcomes are. I think we're going to start to see real pressure for people to articulate how they're approaching it. And we think that certainly we're very well placed for that. So like I said earlier, we welcome that. The headwinds on both sides is, in terms of the diversity and inclusion, I think the headwind is we haven't really created a mechanism as an industry to think about how best to assess new managers. And I do think we have this mix of diverse owned. Many of us, the majority of us, are emerging. And so then there's this sort of, they get convoluted with one another. An emerging manager is a startup. And I think we do need to think about ways that we can assess those firms and credibly consider them without the artificial constructs of 3-year track record, X amount of AUM, or we're just never going to dig ourselves out of this hole. I mean, in 10 years, we've got a 0.1% with diverse and from 1.3% to 1.4. So I think that will be a continued tailwind, unfortunately, despite the focus. And on the ESG side, I think the tailwind will be reports that look at one quarter's performance and say, oh, well, ESG hasn't worked. So that was sort of, I think we need to be more thoughtful than that. And, the scrutiny is important, but I think we need to think about the horizon implications and the fact that there is a mismatch in horizon when we think about ESG. And as listed equity managers, I'll go back to what Jillian said, the bar for us is to deliver results. If we don't deliver results, we're in the most liquid asset class, and clients can easily move about. So we have to deliver performance so that people can see the ESG influences actually bear fruit within the portfolio. So a little mix of both there.
Great. Gloria?
Yeah, I think I agree that one of the biggest tailwinds is the interest and focus on ESG and impact, and more investors are getting educated, which is a really big thing. And I think more asset managers are getting more sophisticated about how to do it. Information is more available. So definitely that is a tailwind. For us personally, I would say our biggest headwind is the competition for personnel. Our people are getting poached right and left with big dollars. And, we're a small company. We can't compete with some of those offers. And so, we've had employees say, look, I really don't want to leave, but they're offering me double what I make here. And we can't compete with that, right? So I think this market right now for, personnel is just so highly compensated in our industry. And it's so competitive that continues to be a big headwind for us.
I think that's going to be, we're seeing it increasingly being a bit headwind with companies when we talk to managers about it, because of a variety of reasons. A new approach to work, which I think is here to stay. And I think the impact of that new approach either works or doesn't work in some businesses, but people want a different approach to working. Yeah. They want you to address that very specifically. So I think that we're all going to have to learn a whole new way of dealing with that Gen X and that generation, because they have a different approach. They just do. They think differently, and that's definitely some diversity of thought there. As I have 2 young sons. And now I'm going to turn it over to Alyssa to close this out. Thank you, Alyssa. And thank you all 3 for participating. Heidi, Gloria, and Jillian. I thought it was really interesting to hear all of your perspectives on a space that we as a firm care a lot about, and also excited to hear that there are 3 women out there also trying to keep their businesses going and grow them in this difficult environment.
Thank you.
Thank you so much.
Thank you, Susan, and thank you to all of the panelists who are with us today. I hope that they've inspired you, and I hope that High Water Women has been a part of the tailwinds in helping you to do the work that you do and inspiring others to join. So thank you so much. Thank you to everyone who is attending. We will have the replay up within a day or so to share with you and anyone who couldn't make it. And thank you also to our supporters. who make this work possible, the McIntyre Foundation and our very own TriLinc Global, who's been a longtime friend of High Water Women. If you are interested in learning more about how to partner with us, please feel free to reach out to me. My contact information is here, also on our website. And as always, we are a small nonprofit that relies on your support. And if you are able, please consider a donation to support our work. And thank you to everyone who helped make this session happen. The High Water Women Gender and Diversity Lens Investing team, chaired by Caroline Lovelace and Valerie Yuen, and supported by many others. Thank you and have a wonderful day.
Thank you.
Thanks so much.
Bye, everyone.
Bye.
Thank
Bye.
you.